What's up everyone, it's Kadi with Money Investing. In this video, we are going to be talking about a brand new topic, which I haven't talked about on the channel before. I'm going to explain what this is, and I'm also going to share an ETF that is currently paying a little bit over 10% in dividend yield with relatively less risk. So hope you guys enjoy this video and find it helpful. If you do, make sure that you drop a like. Don't forget to subscribe to the channel if you're just joining us for the first time. The link to our Discord and Patreon is going to be down below if you're interested in joining us. And of course, don't forget the fundamental and technical analysis courses. The bundle is currently 60% off. Coupon code Easter is valid until tonight. After tonight, the code is going to expire, so you can take advantage of it. The link is going to be down below. So we are going to be talking about what's called close-ended funds. Okay, so there's a difference between open-ended funds and close-ended funds. They're both a type of mutual fund or an ETF. They can trade on the exchange. They cannot trade on the exchange depending on who the issuer is, but there is a difference between open-ended versus close-ended. Now, a lot of ETFs that you may see in the market, like VOO, VUG, there are a lot of Vanguard ETFs that are open-ended funds. So what that simply means, and I've got a whole list to kind of help you explain what open-ended funds really are, that means that they are open, always open and accepting to new investments, right? If somebody wants to invest in, let's say, VOO or VUG, these are your Vanguard S&P 500 ETFs, they are always accepting and introducing new shares, right? So they can continue to issue new shares. They're open-ended. So for example, let's just take VOO for example, and right now they have 520 million shares outstanding, and the assets under management is about $160 billion, right? And the price currently is trading at $375. Now, if there is a new demand, let's just say, for example, tomorrow, Monday morning, there comes in another $2 billion worth of demand for VOO, what's going to happen, right? Demand and supply. Ideally, if the demand comes in, the price should move up, right? But that does not happen in open-ended funds because they want to keep that share price, which is the price of the actual ETF, very much in line with the NAV. That's your notional, or that's your net asset value, right? And so new demand comes in at $2 billion. So what happens is that they actually increase the number of shares, right? So your 520 million shares plus new shares issued through this demand creation, and $162 billion is now the actual assets under management. And so the price remains still at $375. The price moves up and down depending on what the underlying holdings actually do. So VOO, VUG, a lot of these S&P 500 open-ended funds, if Microsoft, Apple, Tesla, all these stocks continue to push higher, then what's going to happen? The actual ETF will also move up, and it'll move down as underlying stocks, underlying holdings continue to move lower. So open-ended funds, one of the main key takeaway from this is that they are always open and accepting to new investments, and they can issue new shares so that they can keep that share price very much in line with the net asset value. And most open-ended funds don't actually trade on exchanges. There are very few, like ETFs, such as I mentioned, the Vanguard ETFs that are open-ended funds that have very, very incredibly low expense ratios that actually do trade on exchanges. But a lot of them, actually, you have to buy directly from the investment firms, issuing firms, so to speak. And when that happens, a lot of these issuing firms also set aside, let's say, 5 to 10% cash, so that if there is an investor who wants to redeem their shares, they have the cash set aside so that they can pay that investor for their redemption. So oftentimes with open-ended funds, you're not actually getting your entire dollar's worth. So for example, if you're investing $1 in an open-ended fund, most of the times you're going to invest 90 to 95 cents in the actual stocks, and 5 cents or 5 to 10 cents is going to be set aside, or 5 to 10% is going to be set aside as cash for redemptions. So that is really what an open-ended fund is all about. So, but this video is about close-ended funds, which we haven't really talked about ever on the channel. And this is something new that I want to introduce to all the viewers and all the audience and all the members. And this is what a close-ended fund actually looks like. Now, this is a fund which is not open to new investors, right? The exact opposite of an open-ended fund. It's not open to new investors. It cannot raise any more capital, right? All the initial capital is raised upon its IPO when it's actually doing its initial public offering. So it can't raise any new capital. And the actual performance, right? Whether we're going to see capital inflows or outflows strictly depend on the performance of the fund itself, right? If the fund is actually doing well, then there is going to be capital inflowing, and that's going to drive up that demand, and the price is going to move up. If there is less demand, if there's more selling pressure, if there's more supply, then the price is going to move lower, and as a result, you will start to see capital move out of that fund. So demand strictly depends on the actual fund manager's performance, right? How the fund is actually doing is what's going to drive and dictate the demand and the demand for capital, right? Capital coming in versus capital going out. So there is a limited number of shares available to trade for a closed-ended fund, and there's only available to trade on exchanges, which I'll go over in just a minute. And assets under management are most cases, they are 100% fully invested. Not always you'll see 100% fully invested, but most of the times they are fully invested, and it's possible for the share price to never be equal to the net asset value, right? Net asset value is simply taking into account what you're investing in, right? So the underlying holdings of that fund divided by the shares outstanding, and that's the actual net asset value, right? So for example, if Microsoft, Apple, Tesla, Nvidia, like all these stocks, I own all these stocks, and if the price of those stocks go up, and I start issuing shares against those stock, then if the prices go up, then my net asset value will also increase. If the underlying stocks decrease, then the net asset value will also decline. So that is a little bit different than the actual share price at which this ETF is trading at. The share price is going to be dependent on whether there's a lot of demand or supply for the limited number of shares that are available to be traded. It is a little bit of a different concept, so we have to kind of go over this. And shares in that sense can trade either at a discount or a premium to the actual net asset value, which is the NAV. So after researching a lot, and again, one more thing that I want to mention is that closed-end funds normally don't necessarily use a lot of leverage, and if they do, they're only, I think, required to use leverage as much as 28 to 30%, close to about a third of their actual assets under management. So for example, if they have $1 billion in assets under management, they can only borrow up to 33% of that, right? So 330 million or 300 million, close to that number is what they can borrow as margin, as leverage, to try to increase some of the potential gains for the fund. They can't go over that limit. But the fund that I'm going to be going over today is actually no leverage. They're not using any leverage. And the yield on that ETF, which is a closed-ended fund, is over 10%. So we are talking about Liberty All-Star Equity Fund. This kind of piqued my interest a little bit as I was doing some research on ETFs and, open and closed-ended funds. And I started watching a lot of videos and, kind of really understanding what they're all about to really understand and give you guys some insight into what they actually do. So their ticker symbol is actually USA. So it is literally USA is their ticker symbol. And they are, again, the Liberty All-Star Equity Fund with a dividend yield of a little bit over 10.6%. The volume's quite low. It's closer to 600,000 shares, so it's not as liquid as what I personally like it to be. But again, it's not terrible either, right? So 10.6% is the actual dividend yield. Now, going over to the actual holdings, so if you take a look at their top 10 holdings, these are all companies that we've all heard of. They've got Microsoft, they've got Visa, United Health, we got Charles Schwab, we got Alphabet, Amazon, Booking Holdings, Adobe, S&P Global, and Dollar General. So it is a mix of different companies, right? It's not focused on tech or value or financials or healthcare, but it is a diversified holding. I think it's got a little bit over 140 something holdings, 147 holdings to be precise. And this is a breakdown between asset allocation. 97% is in stock, which is going to be all these companies over here, and another 140 something companies, and 2.6% is in cash. So it's mostly invested in the market. And United States equity over 88%, with German equity over 1.7%, Japan, UK, Canada, others in the Netherlands, and Switzerland is going to make up the rest of the portfolio that they actually have. Now, the way it's actually structured is that the net asset value, in other words, the actual price, if you combine all the shares that it actually has outstanding, right? And then you combine all the assets under management, considering all the shares of stock that it actually owns, Microsoft and, all the companies that we looked at, Microsoft and Booking Holdings and Visa and all these companies, and you divide it by the shares outstanding, you get to a figure of $6.10. Now, if the underlying stocks, which are all the holdings, go up, net asset value is going to go up. If underlying stocks go down, net asset value is going to go down. That's net asset value in a nutshell. Now, the market price right now, the price at which it's trading at, it's at $6.04. So what that means is that it's actually trading at a discount to its net asset value, meaning that you can actually buy this ETF at about 1% discount to what it would take you to replicate this entire portfolio. If you were to go out there and start buying all these companies yourself and build out this 147 company portfolio, it's going to cost you per share $6.10, but instead you can buy this ETF for $6.04, which is a 1% discount to its actual value. Now, this is not a huge discount because historically it's actually traded at much lower discounts, which I'll get to in just a minute. And like it says, close-ended fund, large cap core, expense ratio is higher because they are actively managed. So 0.93% is the expense ratio. So almost 1% is what you're paying in expenses and distributions quarterly. And they are going to be taxed, of course, because the dividend's pretty expensive. 10.6% is quite high. Inception was 1986. And this is the share count, which is obviously fixed because they can't issue any more additional shares. This right here is the actual diversification of the fund managers. So you'll notice that the fund assets are approximately equally distributed among 3 value managers and 2 growth managers. So this kind of adds that additional layer of diversification for this particular ETF, where Sustainable Growth Advisors LP is focused on the growth side of it, and TCW Investment Management Company also the growth side of it, and then 60% of it is going to be on value, which is going to be your investment management over here, fiduciary management over here, and Aristotle Capital Management over here. So it's kind of like a 60-40 split between value and growth. This right here is going to be distributions, so very consistent distributions, paying investors that dividend yield on a more consistent basis. And this right here is going to be pricing information, which tells us at which points in time the market price was trading at a premium or a discount to the actual NAV. And you'll notice that for the majority of 2021 and even in 2022, the price was actually trading at a much higher level than its actual net asset value. So we're trading at a premium. More recently, though, it has been more in line with its actual net asset value. And in the past, back in 2020 and 2018, it was trading at a huge discount, something as high as 5 to 10% historical discount to its actual net asset value. So for me, I'm definitely going to be doing more research on this because 10.6% dividend yield for almost an identical correlation to the S&P 500, because I did do some analysis on both the USA, and if you take a look at USA divided by SPY, you'll notice that the correlation comes up to 0.01. They're almost identical to each other, meaning that if SPY goes up, USA goes up. If SPY goes down, USA goes down. So they have a positive correlation with each other. So you are pretty much getting exposed to some of the large cap core companies in the US while getting paid 10.6%. But of course, the expense ratio is a little bit higher in the first place. But I wanted to introduce this idea of closed-end funds, and we're going to be diving into this a little bit more detail to kind of understand if there is any opportunity with respect to the higher yields that these funds have to offer. But let me know your thoughts down in the comment section below for this. USA is something that I will be analyzing and doing some more research on. It is not using any leverage, and of course, it's been pushing higher since 1987, consistent gains of over 3,600%. From its great financial crisis, up a little bit over 840% with that very nice dividend yield of over 10% as well. So hope you guys enjoyed this video, found it helpful. If you did, make sure that you drop a like, subscribe to the channel. Link to our Discord and Patreon is going to be down below. As always, happy investing, and I'll see you all in the next video.